Hey there, you're listening to Paradigm Shift, a podcast about people building the future and pivotal moments in their journey. Today, we're super excited to have Cameron Peake on the show. Cameron is a partner at Restive Ventures, which is an early-stage fintech-focused VC fund. Previously, Cameron was the co-founder and CEO of Azlo, a company that provided online banking services to small businesses, entrepreneurs, and freelancers. They quickly grew to over $1 billion in deposits. Cameron has a deep and unique understanding of fintech from multiple vantage points as a founder, operator, and now early-stage investor. Welcome, Cameron. We're excited to have you on.
I'm so happy to be here. Thanks for having me.
So we kind of want to go back to the beginning of your career, or at least the very interesting part of your career. Then we're going to transition a lot into, Aslo and what you're doing nowadays. But I know before you got into startups and venture, you spent 6 years in the nonprofit world. Could you tell us a bit about that, how you ended up there and what kind of things you drew from that experience?
Yeah. I think it was actually really formative. I can go into it a little bit more, but, I ended up going to business school after that. And I realized what kind of creative freedom being a nonprofit gave you, where you weren't beholden to P&L, you could be super creative. And I think it just informed my outlook and a lot of my path coming out of it. But I went into it, I actually studied international development in college, had gone into PR and media after that, but decided I actually wanted to kind of double down and do it. And I joined as the assistant to the president, which I thought would be a great vantage point, both to see what was happening vertically across the NGO, and then horizontally. I was actually based in DC, and I'd be like 23 years old and going to represent her at like North Korea policy meetings. So it was just kind of like a crazy, entry point into what was going on. And I realized pretty quickly that my brain thought in more of a business and technology oriented way. And the nonprofit actually had a team, their innovations team, that was creating ventures that could reach millions of people, be financially sustainable. And what that meant at that point in time was it was really mobile money, digital banking. People were willing to pay for better, safer, cheaper access to financial services. With the proliferation of mobile phones, you could actually distribute financial products more cheaply as well. And so that was actually my start in fintech. And so while I was there, helped to launch a mobile payments product in Zimbabwe, which was a lot like M-Peso, which is kind of the big kind of breakthrough at the time. And I think we were the second mobile money product to reach 1 million people within like 6 months or some like crazy short amount of time. After the earthquake in Haiti, launched a mobile payments system there, a wholesale digital microfinance bank in Indonesia, something else in the Philippines. So I really got to see what fintech looked like in different markets, the importance or lack thereof of regulation in certain places, customer behavior and how it was different. And that really just kind of, I got the itch, I got the bite, or it was for fintech. And I was just really drawn to how you could leverage digital technology in some way to improve financial products for new markets. And then from there, as I mentioned, went to business school, realized that it was this sexy thing called fintech, that there was a lot of innovation going on in the US, and kind of the rest is history. But it was a very fun start to my career.
That's amazing. And that's so interesting, because I think the whole point of fintech is to increase access to things that people can use to improve their lives, right? Like access to credit, access to banking. And would love to just hear a little bit about, as you were building products for underserved folks in places like Zimbabwe and Indonesia, what were the problems you were kind of solving for them? And how did you build products at a nonprofit? Because building these products is hard. How did you bring some of this to market?
So on the problem side, I mean, the big kind of meta trend across all of these markets was, and still largely is today, that banks were serving 1% to 2% of the market. And everyone else, you had to keep your cash under your mattress. You kept it in the form of a goat or jewelry, which could be stolen or lost. I remember talking to one person in Indonesia where, they were a small merchant. They had a kid going to college on a different island. And when he needed to send his kid money, it would take, he'd have to shut up shop. He'd drive 45 minutes to the bank. He'd wait in line for an hour and a half. He'd pay X amount of money to send that payment. And then he'd go back. He's obviously losing kind of revenue at that point in time. And so, I mean, the problems were multifaceted, right? The fundamental one is just like no access to efficient, financial services, safe financial services, period. And then after you got into the product launch side of things, education was a big one. Like, how do I take my phone and actually use that to transfer money? Access and actually cash management, because you typically needed like a cash in location and you were dealing with cash and actually had to figure out how to collect that across a lot of really distributed touch points, right? Like a number of things kind of around that. On the product development side, a lot of what we did, and this is one of the reasons I ended up stepping back, was we would work with telcos or banks in some capacity to kind of co-create, like do product strategy, distribution strategy. And so, they were in many ways kind of the experts around the building side, and we would help them figure out how to reach these new markets. And ultimately, I wanted to kind of have more of an operational kind of impact there. I think, there were very clear challenges around having the right level, kind of the right kind of talent to do this. Because a lot of these companies were like urban, like the elites would go and work there, and they were trying to, like provide financial services to farmers in a lot of cases. And the cultural divide was likely as large as you and I trying to serve kind of rural farmers in Zimbabwe. And so like the talent that wanted to kind of work with these customers and actually kind of understand them was hard in many cases. Folks with kind of the right entrepreneurial insight and drive were hard to come by. It just was a very different kind of workforce that existed in a lot of these places. So in many ways, like the build wasn't as hard because you kind of knew the product. It was about finding the right people to kind of oversee that vision effectively. That was oftentimes the harder piece there.
So it sounds like there was a couple of products launched. They grew really quickly, but it didn't have the right sort of like DNA or long-term setup and people to really succeed.
In some cases, yeah. I mean, in some cases it did. Like I think in Haiti was an example where it didn't. And I think there were just some like fundamental aspects of the market that made it really hard. Like in a country where I'm struggling just to buy food, putting some additional money to work around digital currency, there wasn't enough uptake there from kind of a market standpoint. In Zimbabwe, it was really successful. And I think part of where we played an important role was like helping be that translation bridge between like Zimbabwean farmers and the big corporate mothership. But like once that playbook was established, they could just run with it. And so I think it kind of depends market to market what worked. And I could kind of go through the whole roster, but like in Zimbabwe, it actually did work. We were able to bridge that divide and kind of fit it into their culture and let them just run it. Again, in Haiti, I think it had some more fundamental challenges that I don't believe that service is around today.
Would love to hear about the founding story of Aslo. So it sounds like you got this you saw the impact that these financial tech-enabled products could have, and then you saw how the advantages and disadvantages of launching these products at a nonprofit, and maybe at some point you were like, okay, I'm ready to do my own company. We'd love to hear about how you got started with that and what was the key insight that you started the company with.
Yeah, I mean, for me, it was a little bit of a non-traditional founding story. I actually built it out of the incubator of BBVA, which is a big Spanish bank. And at the time, they were basically bringing in entrepreneurs to build up what they at the time wanted to create kind of a startup factory where they feed a bunch of startups and kind of put them out into the world. And they were interested in starting an SMB bank. They had recently acquired Simple, so consumer neobank. And for me, it was really...
We had Shamir Karkul on the show, on the podcast earlier. Yeah, he's great.
You did? Yeah. So your listeners probably are well aware of that whole story. And for me, it was crazy that I could start an account for a farmer in Zimbabwe within, and they could open an account within a couple of minutes. And in the US at the time, it would take a couple of hours, a trip to a branch. And that juxtaposition was just really crazy to me. And so like that core insight was what propelled me there. And then, I had a really interesting kind of launching point doing it within a bigger bank and as I sure laid into some advantages and some challenges there as well.
Some of that is still true, right? Like opening an SMB account with a traditional bank is still, I think, like can take some time. I'm trying to open an account at SVB right now as a startup, and I have to like call with someone. So why do you think that is? Why is it so hard to open a bank account with a traditional bank? Like, what did you find was like the root cause?
When we started, I mean, it was just, it hadn't been done before and there was no pressure on it. And so I think that's like the fundamental answer. A lot of, for a lot of banks, the SMB kind of category, is seen as a watered down commercial product for the most part. And they put much more energy and attention in the kind of higher margin product. And, there wasn't any real pressure to modernize that SMB experience. Today, where there is a lot more pressure, I think there's a couple of reasons driving it. One kind of continues to remain like the commercial side is much higher margin. If I'm going to, invest in upgrading infrastructure, it's probably not really going to be that side. Another reason is there's a lot of kind of structural things that you see within banks around wanting to pull in more established businesses. So I've been around for 2 years. I have some track record. It kind of de-risks that investment. And I think the really low friction onboarding appeal to newer companies, but they don't really care about things quite as much. And so I think fundamentally it's this mix of, just attention and kind of modernization occurring elsewhere within the bank, and then it not really sitting with the sort of, it not being as important with the sort of customers that they actually want to attract.
So how did you guys think about the primary problem you were trying to address with Aslo? And how did that kind of evolve over time? I'm sure some ideas and then, you sort of like learned new things. So would love to just have you take us through like what some of the initial like problems or hypotheses were and then like where it started and where you eventually ended up.
Yeah, it very dramatically changed over time because the market really dramatically changed. And so I think about it, there being really 3 distinct stages of our company journey. So the first was, what I mentioned. It would take a couple of hours, a trip down to the branch. It was, a bank account was not convenient. There were fees associated with it for a pretty crappy product. And so we found product market fit very early just by being a free digital account for small businesses, period, full stop. Like no one else was doing that. And we saw a lot of very fast initial growth just around that problem set. As the landscape started to shift, and quite frankly, there's more competition. We kind of deepened our relationship with our customers, both because we're kind of naturally inclined to do that and we were forced to at some level. And so the second stage, as I think about it, was a core insight for us was that our customers, like their biggest problem wasn't that they needed a checking account. It wasn't that they needed access to capital. It was that they didn't know what they didn't know. So a lot of these were newer businesses, first time founders. And so we started trying to meet them there. And my belief, at the time and continues to be that the banking services were a commodity, or at that point were becoming a commodity. Like you could kind of access them anywhere. And so how you think about adding value on top of that became really important. And for us, it was really, really chipping away that primary problem for them. And so we actually created kind of a whole community on top of that account, and a whole kind of knowledge base to help them better run and manage their business. So, we do things like webinars to, help them understand how to run SEO campaigns, or at the time, PPP was really big, how to access PPP funding. We had a whole kind of community group where they could interact and exchange and share stories. This was also during the pandemic for a large part. And so a lot of them were kind of isolated. Many of them were single member businesses. And the overarching thing there was that you're not like my typical bank. That was the feedback that we got. And that drove just a ton of organic growth and kind of broader interest. And so as I think about that kind of second phase of our journey, it was, all right, we've got the banking stuff more or less settled, right? Like there's always room for improvement, but like that's kind of in place. Anyway, like that second phase was really around helping them kind of build and navigate their businesses. And I think the real benefit to us was like building a brand in a community that was really there for freelancers, kind of SMBs more broadly. And then the third phase was building for that market in a more meaningful way. And so as we got more volume and started to really understand what businesses we were most effectively serving, because the small business market is incredibly heterogeneous, as you guys probably know. And we started off just serving them pretty broadly. And I think the main trend that you've seen with SMB services in general in the last few years has been going really deep with certain markets. And we can talk about like why that's beneficial or challenging. But for us, we were continuing to serve a fairly heterogeneous population. And what we found as the kind of unifying trend across all of them was that they were smaller and they were really using their bank account as a source of truth for their business. And so if you talk to them, accounting ledgers didn't mean anything. They were this abstract concept where you could have a loss, but like show a profit. And they really only meant things kind of at tax filing time. It's something that our bookkeeper dealt with. But like actually understanding how to manage your business from that cash account, and eliminating more and more of those accounting services. Like I think I saw a stat at one point that was 20%, for 20% of small businesses, which is a huge number. The accounting, they either don't use accounting services or it's just too complex for them. And so like that was the experience we were really building around. And so that was kind of the third phase that we're like, it was a set of value added services, again, built on top of that core bank, but that really dealt with those kind of early stage, very kind of cash accounting based companies.
I think a lot of fintechs like go through like dealing with similar problems where like ultimately like the financial service itself is fundamentally a commodity and there's like 5,000 banks in the US that can offer it and who knows how many startups. And at some point, everyone has to sort of differentiate and build like some like meaningful like advantage over the competition. And it sounds like for you, in like your first phase was just the core product, and phase two was the community and education as a differentiation. And then phase three was sort of like adding additional tools and like more vertical workflows.
Yep.
What are your reflections on how well those worked? Like, was the phase two stuff truly like differentiated over time? And then the phase three stuff, how truly differentiated do you think that stuff is? Because traditional banks might not build the tools, but there's probably a dozen or 2 dozen startups that eventually will. So like looking back, how do you think about like, what are the true like, accumulating advantages or differentiators that really separate like the great companies from the ones that end up are just like stuck in the comparative mess?
I view that as putting us at a competitive advantage for customer acquisition. So I fundamentally believe, we were seeing 30 to 40% organic growth and like it was basically a bank account and that. And so I think that statement that we heard again and again around this is not like my traditional bank. I think that was driving acquisition. And I don't think it was sufficient over the long run because as more and more, neobanks were coming up that could really speak to a narrow community, right? Like, I don't think that would have been defensible kind of broadly. Like, I think it was really important for us to start to build for a much more kind of focused audience. But it was incredibly valuable for customer acquisition. And I think we were at a point where we were still figuring out who we were building for because we didn't have that same pressure. And then, the third phase, we were starting to see really strong traction with a smaller set of customers. And so, I think we'll get into kind of the arc of the company. We don't really have the outcome to say whether that was effective or not. But we were starting to see strong uptake around a number of kind of autopilot, sort of budgeting and account tools that, I don't know. I at least I believe they were resonating. They were paying for them and continuing to pay month after month. But the outcome kind of was never fully realized to see whether that was something incredibly impactful or not.
What happened? I mean,
the broader thing is, we were part of BBVA more broadly. We were created out of their incubator. There was a lot of kind of vision about spitting us out, but ultimately it came down to some things that were not realized. And when PNC acquired BBVA, they ended up shutting down the entire digital portfolio. Again, I'm sure Shamir talked about that with Simple as well, with us, with a whole portfolio there. And so despite some, interest more broadly, we just shut the doors, which was pretty crazy and, disappointing and sad. And I got taught a lot around the importance of control.
So would love to just double click on that for a minute. So Aslo is probably has meaningfully owned by BBVA, maybe not 100%, but some stake. BBVA gets bought by PNC. PNC is trying to figure out what to do with how to integrate BBVA. Aslo is a small part of it. So pretty low on the priority list. And so, you and your team are trying to figure out, okay, where do we take this? One option is make a pitch to be a meaningful bet within PNC. The other is we make a pitch to be spun out. Why did neither of those work? What were some of the lessons as you explored those two paths?
This is unfortunately told over drinks due to some NDAs. The broader story though is, the strategy for PNC was, footprint, physical footprint in the South, and digital was not part of that strategy. And there was some complexity around charting any other path than that. But
I think that makes sense. It's not making money. It's not part of the strategy. We don't want to invest X million dollars into it. But why not spin it out? I'm just for anybody that finds themselves in that situation, what are the structural challenges with that type of execution?
Mostly distraction from a negotiated deal. Yeah, unfortunate. More, we can talk about it more in a different forum.
Cameron, I want to go back to something you said earlier, which was a lot of your growth was organic, and clearly something was working because you were growing organically, and then you collected, I think, $1 billion in deposits pretty quickly. What were the large customer acquisition channels? What worked for you all?
So organic was big. But beyond that, affiliates was very big for us. I think we're probably the first or one of the first neobanks, period, and absolutely the first SMB neobank. Just have a very sophisticated affiliate program in place. And I really credit that with head of marketing that I was able to bring on kind of midway through our journey to really up their game. I really understood SMB acquisition. We had a lot of partnerships. So we were partnered with Stripe Atlas. So every LLC that was open as part of Atlas had an Aslo account. And that was probably our biggest partner, but we had basically a private API where anyone who was serving SMBs as a network was able to offer them seemingly seamlessly a bank account as part of that. And so that was a really interesting channel that we actually didn't pay anything for. It was a position as a service for them. And then kind of standard, just SEO, Google AdWords, basic influencer stuff. And then we had a pretty strong content game. So part of that community that we were building up, all of that content we actually placed and allowed to be part of just kind of organic search as well. And so it both fed into our community and kind of organic work there, but also had a long tail on the search side as well. My core belief about SMBs, especially if you're not working with a narrow niche, is that because it is so heterogeneous, you do need a really layered strategy to reach them in different places. And we absolutely had that.
So, how did you guys set up an affiliates program? For the listeners, how does that sort of thing work behind the scenes?
You can find a broker that can actually help you navigate it more easily. I think it can be kind of cumbersome to set it up on your own. And the brokers don't charge too much money. We actually ended up, again, due to our head of marketing, we actually ended up bringing someone in-house to do this. But there's a couple of things that you need to have in place to make it successful. So one is you need to make sure that you have kind of UTM, appropriate tagging to actually track when someone comes in, and like all of that data needs to be set up, because if that's not in place, a lot of platforms just won't take you, period. And then you need to make sure that you have, again, kind of the infrastructure to be able to service that more broadly. So people that are doing the reconciliation, kind of tracking things more broadly after that. And then again, you can work with a broker who can go out and find the appropriate platforms to place you in. There's a couple of platforms now that you can go to directly. I've heard kind of mixed reviews on them, like Commission Junction is one of them. But it's really about just like growing that broader presence. And then you start getting into like pricing and negotiation. So like with your preferred partners, you might have some separate pricing tier. And then with others, you just kind of offer a standard price based on what your CAC is or however you want to price that channel. But I'd say like the biggest, like two kind of biggest unlocks for me, one is just having like all that technical infrastructure there, because it's impossible to manage without that in place. And then the second is just having someone like a broker or even assigning someone on your team who can really navigate that world, because you get very small and very niche, and you just need to figure out how to talk to them in a really scalable manner.
You find these partners and then they have relationships where they can put your like offer or market your product within like websites, publications, like where's the traffic coming from? Like,
yeah, typically. So like think about it as your
like AdSense almost.
Yeah, or even like say it's one of those wedding websites, like, you know, how do I set up my wedding? And like embedded in it are going to be links to preferred partners. And so that's kind of the long tail of them. So one might be, you know, some blogger writing about small businesses. And as part of that, they have kind of plugs they'll give for bank account. And then, you know, the biggest one we worked with was probably Fundera, which was acquired by NerdWallet, where that was search around, you know, what's the best bank account I could use? And they go in and analyze a bunch of them. So you see this like huge stratification across like tiny little niche plays and bigger ones. But it's really about them creating some type of content, having you be a part of that content piece and getting traffic through it.
Yeah. Got it. So before we move on to like some of the challenges, like specifically, you know, fraud is one you had to deal with. Like, can you give us a sense of like the economics of a neobank from a customer's perspective? Like, you know, what was the ballpark? This was a while ago, right? But what was the ballpark numbers to acquire like a meaningful customer? And then what were the economics like? Where were you making money? Where were you losing money? And then we'd love to get into like fraud, which we know is like a challenge.
Yeah. So ours were a little non-standard, just given our bank partner. We were working with BBVA as our bank partner. They had an API platform at the time. They were not Durbin exempt. So, you know, the broader theme with many neobanks is that they're working with smaller banks that are under 50 billion in assets, and they have kind of preferential economics around debit card interchange. We did not have that advantage. So most of our revenue actually came from interest on deposit. And the thing about BBVA was that they were a regional bank. And so many regional banks are a little bit more deposit hungry. And so we'll actually incentivize for that. And so for us, our CAC was like $40-$50, which was compared to $500 at the time for like what a typical bank would pay for an SMB. So like much, much better. Our primary kind of revenue line item was interest earned on deposits, which fluctuated over time. And so one of the other kind of like more business drivers for those value-added services layered on top was that like monthly SaaS income was much more stable than, you know, an interest rate that would fluctuate widely. And, you know, we were operating during COVID where, you know, the Fed dramatically cut rates, and I saw my revenue kind of cut by similar dramatic rates. So, you know, for us, like interest was the primary driver, debit card interchange was kind of the second. And then we had some kind of nascent but growing recurring fees and kind of lead gen fees. But again, I'd say just for like a kind of a ballpark, our payback period at its height, kind of when net interest margin was highest, was about like 6 months. At its low point was probably 10 to 11 months. You can see the wild fluctuations just around earning money off of interest rates and like why, you know, it was also kind of strategic for us to move to something more stable.
And what was retention like for that customer segment? Because I know that segment churns not just because they're price sensitive, but also because they're business thing might not be around forever, right?
Our retention was actually fairly high because we were like, it was a free product for the most part. I mean, again, we had that kind of more nascent subscription product, but it manifested more as dormancy. And what we'd see kind of three behaviors around dormancy. One, it would be like people would open an account, just never kind of use it. So, and then we'd see dormancy around seasonal businesses. And then we'd see dormancy around businesses that arguably closed or churned. But our active rate was pretty steadily like 50-60% over time. So, I think for kind of taking into account active customers and churned customers, that was kind of it.
And the $40-$50 CAC at the time, like you're nothing proprietary here anymore. Was that like for a funded account, like an active account? Like how did you think about like
That was per funded account.
That's great. The payback period is solid. And it makes sense that once you have a bank account set up, you're probably not racing to replace it. It requires a lot of effort. And
I mean, that's why you see banks pay $500 to acquire a customer. Like once you're in, you're kind of in, but it's once you've proven yourself that you can kind of survive beyond that initial 2-year cycle, right? Going back to our conversation at the very beginning. So, it is a very sticky product once you're in and using it.
And how do the economics compare for like, how much money does Chase make on their deposit account versus like Bank Simple or Aslo? Like, are the economics worse because of like the way fintechs are set up, or are they comparable?
The way that banks typically think about making money off of these accounts is through cross-sell. So like that's the big rule of thumb. Let's get them in and we'll cross-sell them an insurance product and we'll cross-sell them a loan and all of that, which is again why commercial accounts become kind of more valuable. Fluctuates widely based on bank and like service offering. But like the revenue motivations between, again, a Wells Fargo or Chase and it's Simple are very different because the bigger institutions are just much more to cross-sell there.
you mentioned earlier that like one of the reasons, I think you implicitly mentioned this, one of the reasons why big banks don't want to necessarily deal with SMBs is, I'm sure in addition to administration costs, is like fraud risk. And so what was your experience with fraud risk at Aslo, and how did you guys kind of counteract that?
We got burned a lot. I mean, I still remember at one point, I think I told you this before, Zane, but like I still remember one point where we introduced a product, and I think it was like an ACH product, and one person over the course of like 2 days, like we lost $30K or just like one person. Yeah. So, you know.
Oh my gosh. Oh no.
For the benefit of listeners, I understand this reasonably well now, but like, how does that work? Like, what happens that leads to like a $30K loss? Yeah.
It was stupid stuff. Like, we didn't, like this one was that you're always going to have fraud holes around like an ACH, like an ACH pull and ACH debit. And you need to make sure that you have the necessary kind of data and confidence around it. But like, we just didn't put in the right velocity controls. And it's just stupid stuff. And like, so one reason that I'm very passionate about fraud more broadly is there's a lot of vendors out there now that we didn't have the benefit of working with, which I think is great. But there's also just a number of structural things that you should be doing as you build to reduce the risk of fraud loss by a stupid mistake like that. And so like one thing that I always try to evangelize is just like the 5 or 6 basic things that you should be doing so that you can, instead of focusing on stupid fraud loss like that $30K, you can be focused on like, hey, how should I change my risk appetite to allow for faster transfers if we're talking about ACH, or, you know, higher lending threshold if you're talking about credit. But you can actually spend time talking about the strategic stuff and like the growth loss trade-off, as opposed to just like, I didn't have velocity controls in place. So, I mean, I think like a couple of the categories are, there's some things that you should be doing on the front end around controlling for third-party fraud. So kind of using synthetic identities to open an account and then pull funds from another one. Velocity controls is another really big one. There's some basic account takeover stuff you can be doing, especially kind of after you've already open the account. Again, just a number of kind of basic structural things so that you can focus on the more strategic fraud questions instead of stupid stuff like velocity control.
Well, it was also like the ecosystem wasn't as mature back then. And so like today there's like so many tools and there's so much like institutionalized knowledge around this. But I know you had a great blog post on this. We'll definitely link to that in the show notes. So folks can read that to sort of like go deeper.
Evangelize it. Yeah, that's great.
So like the last topic we wanted to talk about in the little time we have left is the fintech landscape. So you've wound down Aslo and you've sort of transitioned into this full-time investor role at Restive, and a lot of it is focused on fintech investing. So what led you into fintech investing particularly, and what are you excited about as you look at the landscape today and like, let's say like the next 5 or 10 years?
I made the jump to investing because after stepping back from Aslo, I was working with fintech founders, kind of went into the standard advisory role, so I haven't recovered for a while after running a company. And I was feeling most drawn to that, like as I actually thought about what I was going to do next. And I'd been working through some startup ideas and kind of figuring out, but I wasn't feeling that inspired by that. I was feeling inspired by working closely with founders, and I was taking like everything I'd learned and just helping other people succeed in their ventures. And so that was the real impetus to move to investing. And fintech more broadly was because we kind of started early in my career. That's what I've really known and where I could really be most helpful. So, that was kind of the reason for the shift. I also, am like very motivated by learning as well. And it was very exciting to me to kind of, learn a totally new industry. And I thought if I ever go back to the founder role, it'll make me a better founder. So, that was the impetus there. In terms of what I'm excited about, I obviously kind of SMB stuff is very exciting to me, but I think the big thread there is kind of fast growing, kind of low cost SMB stuff. And so with those sort of plays, we typically look to have kind of some initial traction data there, whereas in other cases, we'll kind of invest very, very early. I really like kind of anything that's an operational tool for a fintech. I feel like I have some kind of unique insight there based on my background. And I think, a lot of the fintechs out there have been kind of building custom tools where you think about like billing or some compliance ops work. And there's just a whole segment of work that I think, would be better served not being custom. And I think people that are skilled enough to do it. Infrastructure, I really love. Again, I worked with BBVA, used their API platform, and was their first SMB kind of API client. And so got really deep in the weeds on infrastructure there. And I think there are a ton of enterprises out there with really outdated infrastructure. And I think there's a lot of opportunity just to kind of build that out. So, those are a couple, like for me, it's not about, kind of the sexy, flashy thing. A lot of it's kind of internal enterprise infrastructure stuff. The other one I do really like is, kind of industries that are more antiquated industries where there's an opportunity for kind of a fintech innovation. So one investment that we've made is, a company in the education space, like digitizing paper check payments between school districts and their vendors. And I think there's a whole plethora of industries that hadn't really been ready for fintech solutions, but now that infrastructure works to build it cheaply, have teams that maybe came from that area and can market really well, actually build fintech products there. Those are a couple of things that excite me right now.
Yeah, that's awesome. So one thing I'd love to hear your thoughts on is how you think about sort of like long-term advantages that fintechs can build over like building on top of like the more commodity services. In general, I think my observation is payment products have a clear network effect and have generally like been able to compound for a long time. Like examples are like PayPal, Stripe, Venmo, anything that's sort of like a payments product in the flow of funds, like sort of enjoys some unfair advantages. I don't fully understand how to think about that from the perspective of a neobank or a brokerage like Robinhood. So having run like Neobank, what do you think like the most successful long-term sort successful neobanks will look like? And where do you think they can sort of build that edge?
Yeah. I mean, I think there's two categories. One, which frankly for me is a little less interesting, but it's kind of like the Chime, like you got really big fast. And you're basically another Chase or BBVA, but you're just a digital version of it. You have the brand recognition and, you kind of just have that scale. And we're probably unlikely to see that, especially at a seed stage now. I think the other is you're serving a narrow enough but big enough affinity group that one, you get some sort of compounding acquisition advantage there. And then two, you can start to build tools on top of that banking platform that better serve them. Whether that's, Mercury building and venture debt and kind of understanding cap table things and kind of the whole ecosystem of tools that just work for that audience, kind of that sort of play. And you can kind of capture value in a different way beyond just basic banking products.
Yeah, well, I personally believe like most software products can layer on accumulating advantages and network effects over time, as long as there's like traction and like a will to do it. And so I'm very excited to see how this evolves, because I think we'll see some really interesting things come out.
I think the full suite of banking is going to become less important. So like when I first started, I remember I was like, why do we need this and this? And there was belief like you needed to have some level of parity with traditional product. And I don't think that's the case anymore. Like if you just need to have some stored value account and debit card and like a whole bunch of services around it, but actually be a bank replacement, I think that's okay now, and you can really be more of a software layer and just have some components underneath it, as opposed to, again, what it was in the past was more of and kind of for some of the market leaders still is a broad-based banking platform with things layered on top. I think you can really modularize it going forward, which is exciting.
So we have to ask you about the macro environment. Like, since you joined Restive, like there's been like a major like 180 on the macro. Interest rates are rising. It's hurting fintech valuations in the public markets, all tech valuations really. And it's also like upending some business models, like deposits are more valuable now, and like other things like debt is harder. Like, what are your observations on like what this means for like founders and builders in the next like 3 to 4 years operating in this market?
I mean, it really depends on the stage. So, I mean, I think at the seed stage where we primarily operate, like if your business more broadly successful, like it's not really going to matter in 5 to 10 years, right? Like you're just kind of building through the downturn and hope that you don't come up on a ceiling. Obviously, fundraising right now is harder. I do expect that to start to loosen, like, the number of VCs who I talked to 6 months ago, and they were saying they're kind of sitting on the sidelines to see how things go. Fast forward to now, and they're like, "Oh, we're kind of opening up again." I think that will start to change again with some more realistic valuations than we saw a year ago. But I do think capital will start to kind of release again. And then there are some industries that even in the early stages will be harder to navigate. So, I mean, you talked about debt is obviously going to be harder to come by and more expensive. So there's some headwinds there, but I think for the most part, seed stage founders, as long as they're kind of nimble and focused enough, can kind of weather it. It becomes much harder at the later stages. You have, less room to kind of make dramatic cuts. And, there's a number of things that I think make it a lot harder. I have the advantage of that. I get to play in the more fun space. So, I think we're seeing a lot of exciting things out there right now.
So, Cameron, before we get to closeout questions, we want to ask you about Restive. Would love to hear about the firm, the focus of the firm, types of ideas or companies you're excited to fund. Tell us more about it.
Yeah, so we are a pre-seed and seed stage fintech fund. We take a really broad aperture to what fintech is. And so we spend a lot of time talking about neobanks and payment companies. That's definitely within our wheelhouse. But we also love to invest in companies that view fintech or financial services companies as a major vertical, or as I mentioned, companies that may be seemingly in a completely separate industry, but have some sort of financial or payment innovation associated with them. And the big differentiator for us is providing early capital and then deep operational expertise to our portfolio companies. So we spent a lot of time being very in the weeds of everything from the economics of a neobank to fraud. And we really bring that to the portfolio. So we invest year round, but we actually group all of our investments into cohorts. You're in it with another group of fintech founders. During that cohort period, our team is in the trenches with you every other week at a minimum, working through the specific operational issues that you're having at that point in time. And then we run a more structured program alongside that as well, where we've identified what we think are many of the important things to launch a company within the fintech space. So things like industry partners, and we do a partners speed dating day. Things like regulators, we do an annual trip to DC. We either make those connections or bring the knowledge in to help you launch and grow more quickly. And again, we typically invest around $250K at the pre-seed or C stage, and then we'll go up to $2.5 million through that A.
That's amazing. And that sounds really helpful for a founder, since there's so many like details that you really have to get right when you're starting a fintech.
Totally. I mean, I think fintech is one of the most challenging, esoteric kind of industries that you can launch in, and having a set of folks that can help you navigate it could be really helpful.
Awesome. So we have a bunch of questions we like to ask people at the end of the show. And the first one's around feedback. What's the most difficult or challenging feedback you've received, and how have you processed it and incorporated it moving forward?
I did this really impactful program called Leaders in Tech, which is based off of that touchy-feely course at Stanford. I don't know if you guys have heard about it. It's basically like, how can you be really raw and emotionally vulnerable with your peers? And it's like all about stripping you down and, building you back up again. So I did that, which was really transformative for me. But, I think going into it, I viewed like emotion and vulnerability as something that you kind of wanted to hide from the world. Like, you wanted to be the consistent kind of strong leader, and just realized that was actually what made you a great leader. And so got a lot of pointed feedback around like, why are you deflecting with questions instead of like, sharing how you're feeling, or like, why are you, not reacting in this sort of way? And so that like just kind of really cut close and cut down a lot, but ultimately helped me, I think, become a better leader as a result.
Yeah, that's amazing. That's a great lesson. The second question is around superpowers. Everyone has a set of skills that feels like play to them, but work to others. Are there any like superpowers of yours that you found, that you've identified, that you like to lean on day to day?
I think EQ is a really big one. So, I mean, I really enjoy being around other people. I think I can kind of read what's going on a lot of the time. And I think that's helped me just make better connections with employees or peers or others, and lean into it. And I think one thing I've learned about myself is that like, this is an Enneagram thing. I don't know if you guys have looked at that, but like about my kind of color, or whatever it's called. When I'm at my best, I'm able to really collapse an idea into clarity and articulate it really well. And so I think in a lot of moments of crisis, or in like really important moments, I can kind of zone in on what's important and then broadcast it in a way that's really accessible. So those are two things that are fun, and good for that.
Amazing. And the last one's around reading. Are you reading anything these days that's stuck with you, that you think would be interesting for other people to read? It could be nonfiction or fiction. It doesn't have to be necessarily work related.
I'm reading right now the LBJ biography. That is very insightful, very long. I don't know if I would recommend unless you have a lot of time, but I do it while I'm running and sleeping and stuff. So, but it's been really cool just to. Nice.
Anything that's like stood out to you about it so far?
Two things. One, we were talking before how you have kids, and from a very young age, he just had these characteristics that were there, and he exploited them all the way to the White House. And so it's kind of crazy just how innate a lot of these things are. And thinking about my own kids, just what some of those superpowers and challenges are that they'll have, and they're going to live with them for the rest of their life. So how you can kind of channel them in the best way. And the guy was just a master at working every angle to figure out how he could get what he wants to be successful. And it's always a good reminder to work hard and think about things holistically.
Absolutely. Well, this has been such a great conversation. We've learned so much. I'm sure our listeners will as well. Thanks for coming on. We'd love to have you again sometime in the future.
Awesome. Thanks for having me.